I'm sorry, can you repeat that?
I said, are the weightings about the same between large cap and small cap, or the ability to have a price discrepancy about the same between the asset classes?
I think I think, like obviously I'm still like starting here, but I do think that large cap and small cap, there exists possibility of price discrepancies. I don't think it's unique to only small cap, but I do think that some of these companies are so young that maybe, since you're projecting more into the future, there is a possibility that the gap could be larger compared to a larger company that's more established, and you have more historical data to factor into the price already.
Do you think it's harder to value smaller companies than larger companies based on having less historical data or knowing less about the companies?
Yeah, from what I would say, I would say yes to that. Basically, because there is less past performance to go on, and you are basing a lot of it on projections into future growth. So I think, yeah, I would say that there's more of a possibility, or it's more projection based since you don't have that background to look up on.
All right, thanks.
Okay, so also the next thing I did was look at the Russell 2000 versus the Dow Jones. Russell 2000 is a small cap index. I looked at from June 2008, right before the crash, to January 2010, and despite the higher, it looked like the Russell had higher returns, a lot of points, but it also bottomed out lower during the crash, and subsequently in March as well. I would say that from what I can see, that did look like the Dow was relatively more stable, and I think that it shows part of the caution needed when investing in small market stocks. And when I looked up a lot of research, a lot of large cap stocks do tend to pay higher dividends and be more stable, and so they're still an integral part of many mutual and pension funds. So I think you have to offset some of the risk that you're taking with funds that are more stable. And just to conclude that quickly, so there exists a possibility of high investment returns on small cap stocks when in combination with other factors that could be value investing or growth investing. If you do your research well and you see the potential for exceptional rates of return, that could outweigh the risk in the market for investors. And however, pension funds still do invest high concentrations in large stock funds due to their stability, and you have past performance history to look up on as well. And so then I moved to the super investors part. So to start, value versus growth investing. Value investing centers more around buying stocks with prices that trade at a discount to its intrinsic value. That was called the margin of safety. Value investors believe that the value of the stock is not accurately reflected in the market, and this allows for the possibility of higher returns in the future. As compared to growth investors who look for the growth potential in companies. This could refer to potential future earnings, or maybe their growth rates are above the industry average for their specific sector. And in that case, expected growth would be the priority over looking at the intrinsic value. However, these are not two. It is possible to combine the two. Warren Buffett said that there's no theoretical difference between the concepts of value and growth investing. Investors are often looking for a combination of these. They're looking for potential growth and a price value that's below what it should be. And these two set the stage for higher returns in the future. But there are limitations and risks involved with both strategies. Like the concept of intrinsic value, that could differ from investor to investor, person to person. As well, there's risk involved in projecting future growth earnings. Since you can't necessarily predict the future, what one person may think is going to happen is not necessarily the same as someone else. I think that is what is reflected in the market on the price. Different people have different outlooks on the price. So efficient market theory. It's a theory that says financial markets are informationally efficient, and therefore it should be impossible to consistently beat the market in risk-adjusted returns. This theory states that basically stock prices usually reflect all the information available and are therefore accurately priced, and investors should not try and pick stocks that could beat the market, but they should basically try and match the market. There's three different strengths of the EMT. The weak efficient market theory basically says you only have historical prices to look on. Semi is basically the one that's most accepted. The information available to the public and past performance factors in the price. And then strong efficient market theory states that all private, public,